Good afternoon, everyone, and thanks for joining us today. This is Erik Brenner here, and we appreciate you taking a few minutes of your time. The advisors and I wanted to make sure that we're continuing to communicate in this very challenging time, as we know. When we kind of think back just a few weeks ago, we hit all-time highs in the market. The economy was floating along, and things were going along, and how fast things can change. So we wanted to cover some things today. So on the call today, the webinar, whether you're joining us via the internet, whether you're calling in, we're also streaming this on social media. So thanks for joining us again. We will be having these every Friday at 3 o'clock until we don't need to have them. And we just want to communicate the latest and kind of how we're thinking about it as a firm. So I have Matt Aurenz. Matt, you with us today?
I'm here.
All right. Thanks, Matt, for joining. And Bill Davis. Bill.
I'm here. Thanks for having me.
Yep. Welcome. And Beth Foley.
I'm here as well.
Great. All right. So before we jump in, couple things as it relates to our logistics and the firm. We've been communicating that we are fully operational. We have gone to and following the recommended protocol of social distancing, and we have folks working remotely, but they are fully functional to make sure that they continue to serve the needs of the clients. Make trades as needed, do requests and so forth. So we are here and we'll continue to be here. And the great thing with technology is we can establish ourselves and set ourselves up to be fully functional as long as we need to be remotely. So that will be good. If you need to drop off checks or get checks to us, if they come via mail, I would recommend just make sure you contact the office first, and how we'll go about that and getting the information to you. And as we communicated, we've moved all of our appointments, client interactions to either by phone or through a Zoom meeting. And we're going to do that at least through April 3rd, and then we'll reevaluate it just to try to keep everybody safe. So with that, let's kick it off. As I said, we really have had, as we know, a market that was driven not financial, but based on the coronavirus and the health scare that happened very quickly. And we've obviously had very much a lot of up and down days in the market. And so I know a lot of people are questioning kind of, how long is it going to go? What should I do with my investments and so forth? So this isn't about individual advice. We obviously take very seriously. Each individual has a different situation, but this is about giving you information. So Matt, why don't you kick us off here? We've got a couple slides. If you are watching online, you can watch those, or we'll talk them through, and we're going to have a roundtable discussion here, all of us coming from our remote offices.
All right, just give me 1 second here. Can you see the screen?
We got it, Matt. Thanks.
All right. I think the first thing that we want to just stress before we get really into some technical stuff is just the emotions that most people are likely experiencing right now. This is not a chart of what the market's doing on a daily basis, but more, in fact, probably what your emotions are going through right now. And so we just really wanted to, bring a little bit of sense of the calm into all of this. Obviously, if you look at the last 10 to 11 years, it's been a relatively smooth ride. A couple years where the market has had some slight downturns, but nothing significant. relatively going from that encouraged to euphoric moment. And, if I look at anything over the last, maybe 2018 provided, the fourth quarter provided a little downturn, 2015, 2011. Those are probably the only 3 years that really had any kind of significant decline in the market towards this surprise or nervousness, but really never anything down into this worried or panic stricken. Maybe people had just some initial questions, concerns, that type of thing. But overall, relatively smooth ride. And so as we experience this, it's the old rule of buy low, sell high. And what we find is that in periods like this, it's very difficult for people, and rightfully so, to stick to that game plan. It's almost counterintuitive. You get to the point where you want to sell down here and buy when things feel good. And so while we understand the emotions that people are going through, we really do want to try to stress this as best as possible. That doesn't necessarily mean you can't make changes to what you're doing, but again, readdress that this is a 2-week period. So far, there's still so much uncertainty out there. And that's really what's rattling this market right now. Sure, there's some underlying fundamentals, but again, it's uncertainty, much like in an election. The market doesn't really necessarily care who gets elected. It just wants to know who's going to be elected. So this is kind of what we're going through. So I'll just kind of open up to the rest of the people on here and let them provide some of their points.
Well, yeah, it's Bill here. We just, Erik opened up with that just 2 weeks ago, we were reviewing portfolios that we were taking profits out of. And that's been happening for the last several years, that we haven't been greedy. We haven't allowed that euphoria to affect our decision making. And so the diversified approach has worked. But to think that only 2 weeks ago we were euphoric, and today we are already dealing with some people that are panic stricken. But that is the nature of the uncertainty that you mentioned, man.
We may look at the chart today, but I think many of us are familiar with the numbers, the statistics that show that people who work with a financial advisor generally do a little bit better long-term than people who don't. And I was thinking about this chart over the course of the day today. And it's been interesting that I have had, many of our clients have called. We've talked to our clients. The 4 of us are actively reaching out to clients and not finding too many folks who are panicked. Certainly people who are concerned and worried, but none of that panic. Where I'm getting the question from is from friends or people in the neighborhood or stores, people who know what I do. And the very first thing they say, and it was exactly the same in 2008, is, oh my gosh, your clients must be so panicked. Is everybody calling in a panic? And they're not. People call and reach out with us with concern, but it's those people who don't have advisors who seem to think that everybody should be panicking. And I think that I can attribute it to using, as Bill just said, diversification in the portfolio, working over time to make sure our clients understand what they own and why they own it and why we allocate. So my experience has been, clients with concerns, people who want to know where they stand, how are things doing, how are they impacted. But panic is not a word that I would attribute to the folks that I've been talking to who are my clients this week, just those who I see out and about, or used to see out and about, I guess, who are not working with advisors. So that kind of tells me where their brains are at and where their emotions are at during the past week or so.
Yeah, thanks everyone. A couple things before I make a couple other comments is, which I did not mention, you can type in questions if you're listening on the computer through the webinar. You can type in questions there. You can also send questions to Erik, Erik Brenner at hilltopwealthsolutions.com. We've got some questions that have come in, and I know we're answering some as we go. And as I think about this further, a couple things. One is all of us here on the call, we have over 100 years combined experience, and all of us lived through 08, 09. And I can remember many discussions in the beginning period of '09 when there was a presidential inauguration and we were going in kind of January, February, and then into March. And the Dow Jones was real close to 5,000 on the Dow. And, you know, at that time, people did think or lead to, can this go to zero? And it went from 5,000 to 29,000 as a high a few weeks ago. So when you think about it from that standpoint, I mean, over the course of period of time, that from 2009 through 2020, February 2020, you know, that is nice and substantial growth. So that's one thing. The second thing is that we manage the way we manage our models. We're not struggling to sell things that don't make sense to sell to get people income. So I think it's really important. Most of our clients are taking money in one fashion or another because they're using it as income. And the good thing that you can be rest assured is, you know, we have structured our portfolios to have enough in cash positions, interest and dividends paying, that it covers immediate needs, oftentimes into, you know, 18 months plus. And so, you know, we've positioned that. Now it'd been nicer to have it longer, but you definitely lose when you sell. And so one of the things with this chart that we talk about as advisors is you just don't want to base it on that. I know I've quoted a lot Warren Buffett. You know, he's got a lot of great sayings, and one of them is to be fearful when others are greedy and be greedy when others are fearful. And so if you go back in February, March of '09, Warren and some of the other top money managers were buying as much as they could. So we don't know where the bottom is. It feels like it's been a little bit of a trading range here over the last select number of days. But you know, we will get through this. The biggest unknown, as Matt said, is this is a health, you know, the health concern with the coronavirus started it all. It was not on the financial aspect side. And the other part about it is that many companies are very strong and well managed. Certainly there are industries that will be affected, no doubt. Unemployment's going to go up, no doubt. But I think there's a lot of really very strong companies, and they will get through it. Panel, any other comments?
I think the only thing I would add to that is, you know, this is a great opportunity to just control what you can control. You know, in this period, you know, most people are working remotely, kids are at home, all sorts of stuff going on. And so, you know, control what you can control. I know for me, things I can control is I'm probably not going to eat at a restaurant for the next couple of weeks. So that helps my cash flow out a little bit, you know. And I say that jokingly, but at the same time, if you're just going to worry about all the things that you can't control, it really becomes much more of a nervous and worried category. So just take a little bit of time to look at your finances and say, what can I push out? What can I do without for just a little bit? Or even where there are opportunities, you know, just really pay attention to those types of things to just, again, just readdress your situation on a week-to-week basis. Like everything else that's going on, it's a week-to-week basis.
You know, if I can add to that, Matt, this is the things that you can control. I would strongly recommend not checking the markets and checking the Dow on an hour-by-hour basis. You know, I think it makes sense to stay informed, maybe as you're watching the news in the evening. But looking at the markets every half hour, every hour, that's only going to lend to that nervous and worried part of this graph that we're looking at here. So you can control that. So, turn down the dial, turn off the TV, just stay away from that. Check, once a day to kind of see where things at, if that's something that you need to do or want to do. But it's not going to do anybody any good to look at those numbers on an hour by hour basis. It really will just add to stress and worry. And when we're stressed and worried, we don't make good decisions. So I would add that to Matt's recommendation to control what you can control.
So panel, here's a question that came in. So obviously we've got a lot of aid packages going on that's going to total in the trillions. How does it impact? It's impacting America's debt and impact on inflation in the markets kind of going forward. Who would like to address that?
Yeah, I can talk to that, Erik. There's no doubt that this is the time that big government is required to step in and infuse capital into a system that is going to be in need of it. You mentioned specific sectors. That will certainly be leisure, that will certainly be travel, that will be airlines, that will be, a lot of different areas in addition to unemployed people and things like FMLA funding. It's going to be an unprecedented amount of money. You're right. It's going to exceed. It's going to be in the trillions, but recognizes that's what big government's there for, and so it's going to happen. It's going to add to our national debt, but it's going to be the backstop for this economy, so that it's we are expecting -8% second quarter GDP, which will probably be the fourth or fifth worst GDP quarter in the history of the country. Well, that's the kind of unprecedented timing that's going to require Big Daddy to fund us to get out of this in as short order as possible, which we think that third quarter will probably be flat like the first quarter, and we'll return to maybe 2% GDP growth in the fourth.
Thanks,
Yeah,
Bill.
and I'm hearing a lot of stuff too. If you're watching headlines, this is actually a really good opportunity, I think, for investors to begin to see what organizations are you a patron of? What are you investing in? And I think what we're going to experience is a lot of companies and organizations that begin to really pay attention to how they're treating employees and how they're treating their customers. Some personal experiences. My spring break trip next week is canceled, and my condo that I rented, or cabin, reimbursed the whole fee. It was only supposed to be 75%, but they said, here, we're going to give you all your money back. We understand the circumstances. Restaurants downtown Valparaiso, the landlords are saying, hey, we're going to waive your rent for a month. CEOs at big firms are saying, hey, we're going to cut back our salaries to help out with cash flow. So there's a lot that's going on that's going to be just beyond big government at this point, that is going to help stimulate some type of economic recovery. And I think that's really going to help way more than people give credit for. Or those are the things that, let's just put it this way, aren't making necessarily major headline news. And while those might offset profits elsewhere, they are going to help stabilize communities as a whole. And I think that's going to be a really important aspect of rebounding this economy. And I also think it's just going to provide people with extra cash flow to spend in places. And they are going to start paying attention where they spend their money out of this. I can guarantee you that.
Yeah, thanks, Matt. Appreciate those comments. I think we have one other slide that we talked about, Matt, that if you want to reference that and bring that up.
Yeah, so this one is just really going back to in a volatile market, why stay invested? It's obviously a difficult thing to do, but again, it's really stressing if you were to miss from January 1st of 2000 to December 31st of 2019, if you were to miss a certain number of up days, the largest number of up days, what the drastic result would be. And what it speaks to is, well, I'm going to sell now because I think the market's going to continue to decline. But the complexity is, when is your re-entry point? And I think that's the hardest part, is when it comes down to timing, is when do I buy back? I mean, we saw a couple days ago, well, I missed out on a 2,000 point upswing in the down. Now, a couple days later, it's down, right? And so you could argue it both ways, but numbers don't lie in the long term. And that's what this is referencing, is there is a reason to stay invested. You're still collecting dividends. You're still collecting interest. You're still owning the same number of shares. And in fact, if you're allowing those to reinvest on a regular basis, you're purchasing more shares at suppressed prices, which will help with the recovery. So there is a real case, obviously, mathematically, for why we're doing what we're doing. As hard as it can be at times, it does make sense.
Yeah, and we've experienced this, with the 08, 09, where now if you think back, I mean, I'm sure many on the call had that, wow, when's enough's enough. Now I would say a couple things. One would be, the dips, when they go, it seems like they've been large. And so, our investment committee team has had some discussion briefly now, because we're really focusing on the here and now, but we've had it in the past as well, as how to protect the downside. Our models, as we have communicated with the alternative allocation, alternatives are down. I mean, precious metals, oil, and so forth, but it still helps buffer some of the downside. And in the future, we will continue discussions once we get back to some normalcy as it relates to markets and investment strategy. We'll talk about, okay, what is it, and how do we protect the extreme downside? There's the up and down, and there's the downside. But Matt brings a good point. Is this right now is not the time. If somebody did it 3 weeks ago, maybe it's certainly not down as much, but you definitely lose when you sell. And as long as you can get through and you have your income coming in and you get through the period of time, you'll feel like you did coming out of 08, 09, and where we're going. So that brings me to another question. And this is a very good question. And I know a lot of people ask it, or think it anyway. And I will say that, in our conversations and around the panel, they can comment on the conversations they had. And, I've had some clients ask me, how are the other clients responding? Are they selling? Are they panicking? And really not, which we think is good in the long term. But no one likes where we're at, but, we've got to make sure, again, we don't base it on emotion. So this question is, is there ever a point where us as a firm or a financial advisor would say, get out and sit on the sidelines? So somebody want to take that? Because I'm sure most people think that at some point.
I can go for it, Beth.
Okay, thanks, Matt. So that question has come up. I remember that question on a couple of occasions back in 2008, and not so much so far during this immediate crisis of, should we just sell out and sit on the sidelines altogether? And my response to that is, that's an incredibly individual position to be in. I couldn't say whole scale, yes, absolutely, that should be an option. I don't feel that way. I feel very strongly about the chart that we're looking at. But sometimes action does need to be taken for peace of mind, or because of an immediate need that may come up. So I think that there is occasion, and I've actually executed on a couple of these over the past couple of weeks, where although it is selling in a down market and not knowing when the turn is going to be, or when the best time is going to be buy back in, but unique and individual circumstances where we did decide to sell, to bring up the cash position a little bit, to make somebody just feel better about their long-term cash needs. So it's a really good question to have with your advisor, and really kind of hash out the circumstances. What is leading a person to want to get out altogether? Is it pure emotion, or are there some specific needs to say, I do need more cash, or I can't sit through this any longer? That there would be circumstances where that could be appropriate, but I think it's an individual conversation with the advisor, and trying to disseminate what your own thoughts are. Are we working on emotion, or are there specific circumstances that would call for that to happen? Is how I would approach that.
Yeah. So is it the percentage? That's a great point, Beth. And I think that, and others can comment, but is it a dollar amount that you see, or a percentage? And if you want to take some risk off the table, but yet have an opportunity when it goes up, if it keeps you awake at night, then there probably needs to be some changes. But that's the big thing. Beth brought it up, when to get back in. So if someone makes a change, it's okay. When will you be comfortable getting back in to try to regain some? And usually it's already too late, because it happens so quick. And that's why we were showing this slide. So
I think the other thing to add to that is, we're right now, we're essentially speaking to equity markets, right? But there's a lot of other portfolios are diversified. They're not going to be 100% in stock. And so if you're that person who needs cash, or you want to take some money and put it into cash, those types of things, you can really isolate what it is you're actually selling. So you don't necessarily need to sell my large cap stock holdings that are down because I need to get $5,000 or $10,000 from my account. I can cherry pick what I am selling to generate that additional cash. Those are things that you have control of. And again, so if I go back to what you can control is, I can pick and choose what I want to sell, when I want to sell, and how I'm going to do it, and at what rate. So I think that you just have to pay attention to that. Just because the market's down doesn't necessarily mean everything in your account is down. That's number one. Number two is I think of this as a moment. I go back and think of conversations I had with people in 2012 and 2013, and they're saying, "Oh, I wish I would have bought in 08 and 09 after the market was down. I wish I would have bought more. I wish I would have bought Apple, or I wish I would have bought Netflix or Amazon." There's always something that they're attributing to what they should have bought, and they see it. Man, if I would have only known then what that price would be worth today. And so I also think this is as an opportunity. We can come from it as a uh-oh, I'm scared moment, or we can come to it as a, wow, I haven't seen market prices this low. It's only been 3 years. I mean, you're talking January of 2017. We haven't seen markets at this level. So it's not like we're even going anywhere close to 08, 09 numbers. And so you could go back and say, okay, hey, this XYZ stock is down 40%. Do I think that we're going to be in the same position 3 years from now? And if the answer is no, I believe that will have increased, then I'm looking around scrounging up cash or repositioning some conservative assets in my account to say, hey, this is a huge buying opportunity. And in 3 years or 4 years from now, I'm not going to be the person that says, I wish I would have bought XYZ stock. So, you can come at it from two fronts. And so I'm going to come at it from the front of saying, hey, I really have to be cognitive of what's going on right now. But at the same time, do I think that this is going to be a long-term thing in the equity markets? Probably not. I'm probably going to experience some pain in the short term, but long term, I'm probably not going to be here. And so, again, look for those opportunities and really address what can I do in this opportunity moment.
And Matt, you're right. That's a proactive step that people can take to make themselves, kind of calm the emotion a little bit. It's like, what can you do? And there are opportunities in the market right now. If somebody's been watching a particular company and thinking, I'd like to own some of that, but it's too expensive. Well, now may be the time to get it. And a client actually reminded me just about an hour or so ago somebody who has been making some opportunistic purchases over the past couple of weeks, reminded me that she said to me, you know, let's get together in a couple of weeks and start working on an exit strategy. You know, because they have purchased some things that they thought, opportunistic is the word. These are down. We think they'll do well in a year or two, whatever the case may be, but may not be things that fit in their long-term portfolio. So in buying it, keep, you know, controlling the things that you can control. The next step is saying, okay, where is our exit strategy? What are we looking for out of this investment before we decide to sell and move on from there? So the opportunities exist. And, you know, it doesn't have to be a lot of money. If if you're scrounging up $1,000 or two, there are purchases to be made that can help you take advantage and maybe benefit out of this crisis in the long run.
Yeah, we've had some conversations, I know all of us, about people actually changing their risk to more aggressive. So, you know, and that's that advantage side of it. One of the questions I see here, and maybe Bill, will let you take this one. Currently don't have a lot of cash, but have a really poor performing mutual fund. Should you sell it and use the cash to buy a better fund that will grow faster, maybe be a better fund overall or a better investment?
Yeah, that's there could be a number of issues with that. You know, I need to know if it's in an IRA or not in an IRA. Is there tax implications to the transaction? But yes, I would be in favor of selling low and buying low if the expectation of what I'm buying into is going to significantly outperform the historical performance of that investment that I'm selling.
Yeah. Yeah, and we've got enough historical data, right, on many of the investments and what we use to determine, you know, how it's managed, what's the upside potential, you know, all of those types of things. So I think it's a great point. I think it's a point to say you can kind of weed the garden a bit. So,
well, and I would add, Eric, to that you know, you may be changing sectors with that money. So you may be saying that I'm going to, you know, I'm going to underweight international, and I'm going to go and take advantage of the buying opportunity in the small cap sector, for example, or the mid cap sector. Mm-hmm. And I think the small cap sector index as of this morning was down 37% in 2 weeks. So, you know, that would be a place that there's opportunity. Or you might say, well, I want a little bit more stable companies, so I would get more into a mid cap ETF or something. So you might be taking that money from one sector to another that might make sense.
You know, another area with that too, Bill, would be a little bit of the housekeeping issue. If you're hanging on to a mutual fund that maybe is in a non-IRA account that's had some significant capital gains, and maybe you've wanted to get out of the mutual fund and go to something that like an ETF that would be a little bit less costly from an internal perspective, that maybe this is the time to clean house a little bit and saying, all right, I can sell this mutual fund now. I don't have to worry so much about, you know, the cost of capital gains in there, and it gives me an opportunity to slide into an ETF or an individual stock or a different sector that may have lower costs or better growth opportunity over the long term. So just a little.
Good point. Good point, Beth.
Yeah. Yeah. Thanks. And we'll talk in future calls here on the Fridays, check-in Fridays, and talk about other opportunities. You know, there's maybe some losses in non-qualified accounts, take advantage of some capital losses, Roth conversions, and elsewhere. And we appreciate the questions. I'm going to take probably one more here. We don't give the names because we're not allowed to under restrictions, but we certainly appreciate that. And as you go about next week, I would think about as you have questions, hopefully you'll join us next week and for another update. So this question is, thinking back to 2007, one would have been thrilled to see a market outlook in the future, 2020 timeframe of the market being 20,000 plus. Is this really more of a correction of the markets influenced by the current pandemic? I think that's an interesting question. Who would like to start that discussion?
I do believe that this is probably a little bit more than just a correction. based on current levels of the market. I think you also have two things. One is you have the pandemic, and the number two is you have oil. And it's kind of the double whammy that hit the market at the same time. And, you know, now you got OPEC, who's basically just already flooded the market with oil, and is now going to start, you know, producing more barrels than they've ever produced before. And so that's not really helping. It's going to help us at the gas pumps for sure. But that's also causing some additional stress. But when I look at it, to your point on fundamentals, you know, yeah, we were at the lowest unemployment in 60, 70 years. January and February were the highest housing starts, new starts since 2007. Corporate profits looked good. Balance sheets looked relatively good. You know, I think you have a couple of things that are going on right now, particularly in the travel industry. A lot of company corporate buybacks of stocks to get their balance sheets looking good because their stock prices looked good and lucrative to buy. And so, you know, they're buying those, and it's unfortunately eaten up all their cash. And so now they need a bailout. The other thing is that I'm seeing a lot of is that's encouraging for me, at least, is you have CEOs and insiders buying their own company stock at rapid rates because they haven't seen prices this low in, again, you know, 5 or 6 years. So there are still some really good fundamental things going on. It's definitely a lot easier for people with additional resources at their disposal to manage and navigate through these times. But I don't necessarily say it's 100% pandemic. I think that's definitely the thing that sparked it. And now we're seeing governments shutting down and quarantining, and that's creating additional concern of, well, how are all these businesses going to stay open? And so some of this, I think, will definitely be priced in when earnings come out. But you know, the market knows that stuff should be priced in, and sometimes can still panic. So it's really just one of those things we'll have to monitor and watch. But those are my initial thoughts.
Yeah, and you know, we think, don't we, around the call here, that you mentioned the oil thing, Matt. It just so happened it was happening at the same time. We do think there would have been some volatility, certainly not to this extreme, but there would have been some volatility that we would have experienced because of that.
I also think that until we get some answers on how we're going to get our arms around this virus as a country, and people have confidence in that those answers are correct and that it's going to be over in some kind of a timetable, I don't think you're going to have a lot of people jumping back in that have gone to cash. And people are afraid because of not having the information that we would all like to have our hands on.
Yeah, the unknown, the market, Bill, and, we know that it just does not like the unknown. Matt said that earlier. So, yeah.
Yeah, and I think one other point there, that's obviously why the Fed cut rates as well, right? The goal is, if you push that down, it's going to alleviate some stress on businesses and financing and payments, and and also try to get people and encourage people to say, hey, your savings account and your money market accounts aren't going to pay you anything. Why don't you put that money back in the market where you can at least try to get some gain and growth and dividends? But I was just on a call before this call, with BlackRock, the largest institutional manager in the world, and they were speaking to the point of money markets and the concerns that people would have if the buck would break, that kind of thing. And there's really, at this point, no concern. It's not even on the radar for the government or anybody. So banks are relatively in great shape, and they're even doing things to help small business owners out by deferring their loan payments, that type of thing. So we're very comfortable right now with where the dollar's at, where money market mutual funds are at. So if you hear, well, I heard it dip below, or there's a floating rate one money market fund, that's not what we're referring to, and that's a totally separate ballgame than what the retail person deals with. So you just got to pay attention to the headlines, because they are trying to go for a little sticker shock right now.
Great. All right. Well, so I think we're going to wrap up today. So hopefully just the discussion and kind of hearing from us and how we're thinking about it. We are working hard. The whole team here are working hard to guide everyone through this, and we're obviously open to discussions along the way as well. As I said, it will be every week, 3 o'clock Eastern. Make sure you mark your calendars. If you signed up through the webinar, it will send you a reminder, and we will bring you to kind of updated information as well. And please submit questions. We'll be glad to answer those as general questions that you'd like to get answered. With that, I'll say goodbye for Beth, Bill, Matt, and myself. I hope everybody has a great weekend. And as Matt said, you can get some gas if you can get out. I paid $1.53 this morning, which was pretty amazing. So hope everyone has a good weekend, and we will talk to you soon. Thanks so much.